Hello and welcome to this special report here at XM.com. I'm Maria Pachortiz, and joining me is Senior Investment Analyst Marios Hadjikyriacos. We'll be discussing the outlook for growth stocks. So Marios, with the ongoing war in Ukraine and central banks raising interest rates, investors seem to have no choice but to reduce their risk exposure. Could you shed some light on what growth stocks are and why investors usually cut them first?
Hello, Maria. Definitely. So, growth stocks are just shares of companies that are expected to grow faster than the market. Now, these are usually companies in their earlier stages. They might be unprofitable or barely profitable, and their valuation is usually very high. And most of that valuation relies on what they are going to be doing several years from now. So another way to put this is uh, the high valuations on growth stocks. They rely on hope that the company can grow very quickly over the next few years. And as you can imagine, that's something that can change very quickly. It's a story, and stories can change very abruptly. And that's exactly what we've seen lately. We've seen, pandemic winners like Zoom or Spotify get decimated, and we've even seen more established companies like PayPal, for example, taking a very heavy beating. Now, there are, mathematical reasons why higher interest rates or panic in the market hurts these stocks more. But think about it intuitively. Think about a big shock to the economy. So, for example, if you get a recession, that's going to impact the company in its earlier stages much more than a mature multinational company that's already generating tremendous profits.
And what should we expect moving forward? Is the sell-off over?
Well, that's a very tough question to answer, but let's put it this way. In the last few weeks, markets have absorbed a lot of bad news. We've had war in Ukraine, lockdowns in China, inflation going out of control, central banks raising interest rates into an economic slowdown, and even a recession is back on is a risk again, especially in Europe. So if Europe manages to avoid a recession in the coming months, growth is still going to slow down probably pretty dramatically. So the markets have had to face a lot of bad news lately. Now, when you are in an environment like that and you're a fund manager, you have to play defense. Now, that means bringing leverage down, it means raising cash as much as possible, and just overall, just cutting your risk exposure. And that's what we've seen in the last few weeks. We've seen a very sharp drawdown in the markets. We've seen growth stocks get hit the hardest. Now, whether the market can rebound in the near term, it's really going to depend on what happens with Ukraine. Do we get a ceasefire soon? If yes, then we're probably going to see a very substantial relief rally. Now, overall, even though everyone is bearish and everyone is fearful at this point, I'm starting to get quite positive for the following reason. I think we've priced in a lot of the negativity. The war in Ukraine has certainly been priced in to a very good extent. What the central banks will do over the coming year has also been priced in. So, unless we go into a recession soon, uh, I think that there's scope for a rebound just out of how much negativity the market has priced in so far. So you know uh, it's very difficult, but ideally you want to be positive when everyone else is fearful, and that's exactly the scenario we're in right now.
Marios, thanks so much. And thanks for joining us at XM.com.